The S&P 500 has risen by 16.73% year to date so far, trading at 4,464 points, and we're only a few percentage points away from the all-time highs of December 2021. But with all of the scaremongering going on in the media right now around the US potentially entering a recession, interest rates at a 22-year high, financial disaster in the housing market, and credit card debt hitting $1 trillion for the first time, it certainly doesn't paint a very pretty picture for the US stock market. And with the beginning of a small sell-off now taking place, analysts are now somewhat cautious about what's to come in the next couple of months.
You've been bullish when others have not been.
Yes.
Through the first half of the year. And now that you see strategists sort of bumping up their price targets for year end, Bob was talking about the extreme bullishness now. Does that make you just worry?
Yeah, I think it's a bad sign.
So the questions that we've got to answer are, is the stock market now getting a little bit ahead of itself, and are we now back in potentially the territory of a stock market bubble? And should investors be very cautious about what they're investing in? Or do the overall fundamentals back up a justified and continued rally for the US stock market? Well, firstly, let's address why the US stock market could now be back in bubble territory. And the very first reason is because of hype. Yep, there's a new kid on the block called artificial intelligence, which has got every Wall Street investor excited. And big tech, as you probably would have all expected, has certainly jumped on the AI hype train.
Microsoft reports its fourth quarter numbers today. Last quarter, AI was mentioned 45 times on that earnings call.
Since ChatGPT was launched in November 2022 and AI became the new buzzword in the media, mega-cap tech stocks have absolutely soared. Microsoft up 40.6%, Apple up 18%, Meta up 216%, Alphabet up 43.2%, Amazon up 43%, Nvidia stock up 201%, having recently joined the $1 trillion market cap club from riding the AI wave, despite only having a quarterly net income of just $2 billion. And the reason why I call out these 6 companies is because they actually make up 25.2% of the total market value of the S&P 500, meaning the remaining 494 other companies make up the remaining 74.8%. So when big tech has some kind of monumental shift in price, either to the upside or downside, it very much has the potential to materially move the needle of the total value of the stock market. And with now all of the hype around artificial intelligence and its translation into boosted stock prices, Morgan Stanley have compared the bubble-like euphoria to the investing manias of the past century. And look, perhaps they have a point. The inflationary adjusted price-to-earnings ratio of the S&P 500 now stands at 30.8 times earnings, which, let me be honest, isn't a million miles away from the QE-induced bubble of 2021. And it still trades in line with Black Tuesday of the early 1930s, which then saw one of the biggest stock market crashes in history. So perhaps there is some substance to this argument, but what do you guys think? Be sure to let me know down in the comment section below, because Morgan Stanley certainly aren't the only ones spouting about the AI bubble narrative. JP Morgan have also called out that the AI-driven bubble may actually burst and drag down the rest of the stock market too. And naturally, that'll be because some of the big mega-cap tech stocks that I discussed make up such a large portion of the overall S&P 500. And because those stocks are actually benefiting the most from this AI play, it can actually have a broader influence on the total value of the S&P 500. So if investors start to sell off their stocks because the artificial intelligence narrative doesn't actually translate into any kind of bottom line earnings, or at least in the form that Wall Street analysts and investors are actually expecting, then we could certainly see the market sell off, which kind of begs the question, well, exactly how much may that be? Well, some analysts are already calling out that a sell-off could certainly be on the cards.
If you look at all 5% plus sell-offs in the history of the S&P going back to the 1930s, the median and mean end up around 9.5%. And so we're down 2.8. I think we will get that 9%, and that will be a proper correction, right? And so from there, we'll see. But it's in the etymology of the word, right? Why would we use the word correction unless the implication is that the preceding circumstance is incorrect, which is exactly what it is. If something gets too steep or ahead of itself, it needs a pause, a rest, a break.
There is some technical theory behind this kind of 9% sell-off. If I just point towards this chart of the S&P 500, what you can quite clearly see is that we are in an upward trend for stock market prices as of right now. Now, obviously, markets don't just move in straight lines. They go higher, they pull back a bit, and then they go higher again when we're in a bull trend. So let's take a look at what's happened in the last couple of times the stock market sold off. If we look at the price range of these, well, in the first instance, markets pulled back just over 8%, and then in the second instance, well, markets pulled back down to this channel line of about 9%. And the same kind of philosophy goes here, whereby if we take market prices at the top of the channel and take them down to forecasted market prices at the lows of this channel, again, we're talking about a decline of roughly about 8 to 9%, which isn't necessarily a bad thing, it's just part and parcel of a healthy market cycle playing out. But the question is this most recent market cycle where market prices have increased the best part of 28% since the lows of October completely justified? And do the underlying fundamentals still support a bullish stock market? Well, firstly, let's start off by talking about the Federal Reserve and its monetary policy and how they've most recently hiked interest rates again, which most investors are actually seeing in a negative light. But the chair of the Federal Reserve, Jerome Powell, actually recently hinted that rate hikes could actually come to a pause.
I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
Yes, rising rates are actually used in order to stop an overheating economy. And so far, so good for the United States, because the July inflation report actually showed that inflation has actually dropped from the highs of 9.3% down to just 3.2%. Which actually isn't a million miles away from the 2% target inflation rate. So rising rates, for the most part, have actually done their job in actually stopping and curbing the United States inflation rate actually getting out of control. If inflation does now continue to fall or perhaps stabilize in and around that 2% target inflation rate, then we could actually see the Federal Reserve actually cut rates at some point in the future in order to stimulate the economy once again. I'm not sure that there will be any quick decisions by the Federal Reserve in order to change their strategy, but Goldman Sachs economists actually believe that they could cut rates as soon as Q2 2024. So I think from an investor standpoint, perhaps there's a bit of underlying optimism, not just about the stock market, but about the economy too. And actually, having said that, we're actually at the highest percentage of bullish sentiment for the stock market that we've been all year, at 44.7%. And that's despite the fact that the S&P 500 has pretty much been rallying since the start of the year. Investors now are nearly twice as confident about the future performance of the stock market than they were just a couple of months ago. I guess in the initial part, hiking rates was putting us into a very unknown situation. And I guess there were probably some very real concerns about how rising interest rates could adversely affect corporate earnings, because the purpose of rising rates is naturally to hurt household disposable income, which in turn stops people spending money, and therefore the velocity of money throughout an economy therefore slows, resulting in economic activity reducing, or at least in theory anyway. And because of that, the expectation is that people will buy fewer iPhones, they'll also stop ordering as many things on Amazon, they'll perhaps cancel their Netflix subscription, all of which goes on to hurt corporate profitability. And the reason why that's important is because corporate profitability is one of the biggest impacting influences on stock market prices. The higher the earnings that a company can generate, typically the higher their stock price will go. And therefore, on a collective basis, the higher that the total value of the stock market will be. That's why I find it important to look at corporate earnings, or something called an earnings per share, because it's a good proxy to actually evaluate current and future market performance, because the two things are directly correlated. Here you can see the value of the S&P 500 versus its earnings per share. Now, EPS has been on the slide since December 2021, but what's interesting is that stock prices also took a dip too, but since September last year have very much been on the recovery. Whilst corporate earnings, generally speaking, have pulled back slightly, they have remained unchanged for the last couple of months. There's certainly an argument here about the overriding sentiment of the market on the basis of the current Federal Reserve's position, along with perhaps the AI hype train, along with probably many other factors too, that are certainly outweighing the downsides of lower earnings. But there is one final topic that I wanted to cover, and that's the economy. The US economy has remained somewhat resilient, despite the fact that it's not performed as well this year than perhaps in previous years. However, unemployment remains low at 3.6%. And is still on the low end of previous historical data. US economic growth has accelerated to 2.4% in Q2, which has actually resulted in some banks raising their growth forecasts for the rest of the year. Finally, non-farm payrolls came in July at 187,000, which is certainly helping support the current employment rate. So it's not exactly all bad for the US economy as of right now, despite some market commentators suggesting the contrary. I think we're all just adjusting in this transitionary period in this new phase of economics. Probably stating the obvious here, but the economic conditions of the past 15 years currently aren't our reality. Low rates are a thing of the past and are now no longer reflective of perhaps what's going to happen in the next 3 to 5 years. However, what I will say is the stock market is dynamic enough to adapt to these different market conditions that we're facing into. Psychology actually plays a massive part when it comes to the overriding sentiment about the stock market. And on any given year throughout the course of history, you will always have analysts and commentators that can draw on negative aspects that are going on in the broader economy to put together a thesis as to why the stock market is going to come down in value. But the reality is nobody truly knows about what the stock market is going to do today, tomorrow, next week, or next year. So instead, I personally take the approach of just simply continuing to cost average into the market over time. And that's pretty much the strategy that I have behind my own investment portfolio. And so far, it's worked out pretty well. So I guess to summarize, all I would say is keep calm and carry on investing. Now, if you do want to see what I'm investing in right now, well, I've recently revealed my £50,000 trading 2-on-2 stock investment portfolio. So if you want to check out what's within that, then be sure to click on that video next. That being said, see you over in the next one.